Hello everybody, welcome to the TraderMerlin show. It is your Tuesday edition. Are we on Tuesday already? Yes, it's Taco Tuesday. It's going to be Real Estate Tuesday as well. As you guys see, we've got a slight change to the show here today. I know I'm still dialing in some facts, some of the background, but I know a lot of you were like, we're tired of the pictures not being even. Well, I got rid of the uneven pictures, but I now have like a little bit of star behind me. I will get that fixed, but hopefully you guys enjoy some of the look and feel today. We're going to do a little bit of a different show. I had this lovely lady on Power Trading Radio years ago, multiple times, and we discussed all aspects of real estate. And of course, it's been such a hot market. Things have been just absolutely booming in that area. Really wanted to get her perspective on things. So joining me from undisclosed locations, I guess, around the world, we've got Diana Hill talking housing market. Diana, how you doing?
I am doing great, Merlin. It's so good to be back with you.
It's great. I wish we could be on set, but we'll have to take it step by step. We'll get there eventually.
Absolutely.
Before we dive into all of the good stuff and all the market details, I know a lot of people are already asking questions about their specific markets. I'm going to do something that I normally start off with the traders and investors, which is a profile. So real quick for our viewers, tell me kind of how long have you been in the real estate markets and what is your specific style, you would say, if you had to narrow one down, of real estate investing?
Well, thanks, Merlin. And I'm not sure I want to tell you how long because I've been in real estate since I was in college. I bought my first property in college, and that was a while ago. But it really helped this young woman who had been raised by a single mom, lived in an apartment. Four of us were in a one-bedroom apartment, and my mom was a VP for a bank, and so she could get a loan really easily. And so I went to college and I had some incredible mentors that said to me, and it was in Southern California, Long Beach. I went to Long Beach State, and they said to me, you know what, this is what you need to do. And what you need to do is we need to figure out how to use what your mom can do and what you've got and how we can put this together and get you a little condo and get a 2-bedroom, 2-bath condo. You go ahead and rent out the other bedroom to maybe 1 or 2 roommates, and it can pay for itself, and you can start building some kind of wealth for yourself. Mm-hmm. And that's exactly what I did. And so that was a very unique opportunity for me, and I had some great mentors who helped me along the way. Back in the day, they were guys that were called speculators, and so what they would do is basically, I'm in Southern California, they're by the beach, there's not a lot of land, so mm-hmm. They were really into Venice, and so they'd buy, the house that was falling down, and they'd build a beautiful spec house. And so that's how I kind of got introduced to real estate. And when it comes to a specific niche, so I think of myself as a mom and pop landlord. I've always owned property and most of the time managed my own properties unless they were out of the state for the most part. But the specific niche is that I learned a long time ago, you've got to find properties that are not on the market. You've got to find things that nobody else is competing with you, no matter where the market is. I mean, we're going to talk about how crazy it is right now, right? So specifically right now, if you can find something without any competition, you're going to be in a much better position. But I learned that a long time ago, and that specific niche that I did was probate properties. And so probate properties are properties that go into somebody passes, and they have a property that then needs to be sold, maybe to settle an estate. And so there's a lot that goes along with it. That's very, very simplistic, but it has been very good to me. And I have found some amazing opportunities and deals doing it that way. So I would say that mom and pop landlord and probate is my niche.
I like it. I did the landlord route for a little bit, and I was like, you know what? I think I told you this story, but I had some places in Austin, Texas, and I did Section 8 housing. Ooh. And I know you live and you learn. By the way, for those on Section 8, basically, it's you're talking welfare, government assist. And it was nice because, the check was always coming in, but I had this one tenant, which ruined it all for me. Me and my dad, we had 5 duplexes down there, and one of the guys had taken Playboy magazines. We'll just say, it doesn't have to be Playboy specific, but we'll just say nude women erotic centerfolds. Used wallpaper glue and glued them on every surface in the bathroom. I'm talking the ceiling, the shower doors, the shower stall, the toilet, the sink, everything. And I'm like, your $250 security deposit is not going to cut it for my full bathroom remodel I need to go through. So I got out of there. I'm going more upscale. I don't like the landlord thing, man. It drives me crazy.
Well, and I've been very lucky. I've had some. Everybody has their horror stories, right? But for the most part, and the one thing I've always had the mindset of is that I've always looked at it is that those people are paying my mortgage. They're buying my asset for me. So I've been able to get through a lot of things because of that. But I also have a lot of experience, kind of through other people in my life. My husband's a broker. My son's a broker. He's in the commercial industrial world. Talk about a market just exploding like crazy, especially from COVID. So there's a lot of different aspects of real estate I've been involved in.
Let's pivot to what's going on now, because obviously there's lean times for real estate, there's boom times for real estate, and I've been telling my viewers I'm actually in the process of looking to find some place for myself up in Big Bear. I like to get a little mountain retreat, and I mean the bidding wars are ridiculous up there. I think told the viewers there was a place that was offered for $299 and I offered $310, and the buyers came back and said, well, how about $340? It's like, are you gonna be crazy? There's this big boom going on right now, so I'd love to get your take on the present status of the real estate market. And I have to say, kind of overall, I know that the market in Phoenix might be completely different than New York City, but as an overall assessment, what do we think about the housing market right now?
It's pretty funny you should bring that up. So I'm in Southern Cal. My husband is a broker in Southern Cal, and I listen to many of his stories over dinner. And so it's really interesting right now because of such low inventory, right? We talk supply and demand all the time. Well, real estate's no different. It's supply and demand. And so when there is a real reduction in supply, and then there's still some demand out there, it just keeps pushing prices up. And it's certainly doing that in most markets. And there's a couple of things I think that are pushing that. One, low inventory, also really low interest rates, and a change in mindset in this past year. So we were going through a time with millennials, and I have two of them, so I do not speak badly of them at all, but they were really kind of slower on the uptake of kind of settling down, right? And they were really the mindset was, I want to live where I play and I work. And so we were seeing tons of urban development, right? And that was just really kind of going crazy. And then COVID hit, and all of a sudden, people are now confined to small spaces. They can't get out and play in their area where they wanted to before. And so it started to kind of start that trend of them starting to, that demographic starting to look for, okay, maybe it is time that I find something more settled and that has more space. Also, people working from home as well. So, imagine you have two millennials that are working from a one-bedroom or a loft apartment and wanting that and wanting some outside space. So it's really kind of pushed the market a little bit that way. And but there's not a lot of selling going on, and so when we're looking at properties that are on the market, sometimes we're seeing properties on the market, for, depending if how you look at it, if it says in escrow, they're on the market less than 5 days.
Yeah.
And it's just insane. And so if as an investor, if you are looking for a deal right now, or even if you're a retail buyer and you say, oh, I want a deal, because everybody comes in and says, I want a deal.
Right, yeah.
You aren't going to find one on the open market. It's just not going to happen. So you better use other techniques to try to find something. And then if you're a buyer and you're looking to try to get into the market, there's some things that you need to be aware of and some things you need to know when you're looking at what you're competing against. And a lot of times people think it's only the price that they offer, but a lot of times there's a lot of other things that go in line with making a good offer and being that one that may get accepted.
Yeah. On that line, let's assume that the market prices will stay right where they are. We won't go into the how to find these kind of houses before they come to market. We'll assume that we're going through a realtor, we're using MLS, standard stuff, go through Zillow, whatever you want. Is there a specific point, and I meant to run these calculations for myself. I remember when I sat in some of the real estate courses with you, you had some similar calculators, but Kevin says, when would it be better to buy based on housing prices instead of mortgage rates? When would that switch happen? Because, obviously we're seeing rates jump pretty significantly here. We were under 3% for a 30-year fix. Now you're above 3, and who knows, that could be above 4 if these rates keep rising. But we've also seen the housing prices rise significantly. So is there a sweet spot where you say, you know what, holding this house for 30 years at this rate warrants me paying a bit of a premium for the house?
And that's a great question. And I think one, especially somebody who has been in the market a long time, we see interest rates increasing. Oh my goodness, they increased 0.5%, and people are going crazy. Well, I was around when I bought a lot of properties between 8 and 10% interest.
Ooh, Lordy.
Yeah, I was very young when properties were up at, interest rates were up at 17, 18%. So these are still exceptionally low interest rates. And I think if you look over time, like a lot of people will quibble about paying maybe an extra $5,000 or $10,000 for a property because they feel like they're not getting, once again, a deal. If you look at that amount of money over a 30-year or even a 15-year period of time with the interest rate as cheap as it is right now, that's not as great a factor as a factor of how long do you plan on being in that property? What part of the cycle do you think you'll have to sell that property in? So if you buy that property now at the top of the market and you say that you're going to live in it for 5 or 7 years, you're going to be on the plus side. If you have to end up selling that property maybe in 2 and 3 years, and we've seen a dip in the market, and now you're having to sell it for below maybe what you paid for it or close to even, that's when you start seeing that negative. So if you have that period of time, 5 to 7 years is what we really use to look at the length of time you can hold a property where you're probably going to be in the plus column.
Yeah, I'm actually trying to bring up a graphic right now, the 30-year mortgage, but it's not quite working for me. 1 second, guys, I'll have this. When we look at historical numbers, and I think I can, there it is. It's not the best looking chart, everybody, but just deal with it. This is from the Financial Times, and basically I just wanted to bring this up because Diana was saying that she's, had some at the 8% mark, which I think all of us would just gasp at that one. Imagine, buying something that's cost $500,000 or $1 million, and all of a sudden you have to pay 8% interest on it. Good Lord, that's a lot. You see, this was early 2020. We were at 2.98 for that 30-year fixed. We're lower than that here recently, but historically, on the grand scheme of things, it's still unbelievably low. And I think, there's probably a number that the industry knows better, but my assumption would be that the standard here, the normal rate for a 30-year fix, is somewhere around 5 or 6%. Therefore, even buying right now with this cheap money, which is what I think a lot of people are doing, is probably not a bad idea if you plan on staying in that home for a long time. If it's a couple of year thing, that might not make it worthwhile, because what happens if you bought it today and then in 6 months all of a sudden price drops 20%? Well, if your time horizon is 30 years, no big deal, but if your time horizon is a year, yeah, you might have an issue there. So
Yep. Absolutely. And one of the things that I always look at as well is I always look at what's called Plan B. So if something happens, because we know that things happen in life, right? So I always want to make sure that anything that I'm buying, I've got that Plan B. So if I'm buying something to fix and flip, I'm also going to do the calculations to figure out what can it rent for if I have to hold it. I've been in that situation before, right? I've been in a situation where I was flipping properties and all of a sudden the market went stagnant, right? What would have happened if you were just about to flip something, a year ago today, right?
Yeah.
All of a sudden, it's like, okay, I don't know. How am I going to sell this? How am I going to sell a property in an open house? Nobody can go out. How can anybody see it, right? So you always have to have that backup plan. So for me, always knowing that if I had to maintain the asset and hold the asset and it could pay for itself until I could get to that place back where the market, where I was positive again, that's something that I've always looked at, always having to look at that
Yeah.
that plan B. So, and I think that one of the things people need to be aware of right now, if they're looking at buying, is that the competition is so tough right now that and the other thing is that appraisals are very difficult right now. So just because somebody, like you were saying about the guy you were looking at, just because somebody says they want $350,000 for their property,
Yep.
if they're looking at selling to somebody who has to get a loan, it doesn't mean the property is going to appraise for that.
Right.
So what happens if that property comes back and only appraises at 310? Right? Do you have a buyer who can make up that difference?
Right.
Or do you have an all cash buyer? So those are the things that make an offer a little bit more attractive these days.
Yeah, and I thought my offer would have been, but hey, the thing I've learned, and I look at real estate with a lot of the same, we'll say, microscope as I would look at the trading stocks and futures and forex is. One thing you don't want to get in the habit of doing, or the mistake of doing, is chasing something. And right now, I think that a lot of people are feeling this, I have to lock in and get a 3% mortgage. And that may not be necessarily true. I mean, I look at some of the prices going on in Big Bear, for example, since I've been there. I mean, this same house with the same square footage in, let's say 4 months ago, was selling for about $80,000 less. So you're getting this huge surge in it's like the FOMO, right? And it drives things up. Is it better to chase that and know I'm going to have this house for a long time at a low rate, or let it fall, or similar houses fall in that area over the next 6 months to a year, because people are going to be going back to work. They might not have the vacation home in Big Bear, etc., and maybe buy a piece of property cheaper in 6 or 8 months. So, that's where I'm at right now with my investment decisions. I think for other people it may be different, because this might be your primary home where you're looking to move permanently to a different location. But these are things I think we have to take into consideration when making this sort of assessment of buying a real estate, whether it's vacation or personal residence.
And I think if you're buying your personal residence, that is different than if you're buying in a vacation area.
Yep.
And we really do think that this huge trend and push that it's been, where people have been buying these second homes or vacation homes or something to get out of, metropolitan LA or whatever the case may be, or New York. My God, if you've looked at the prices that have dropped in New York and then that have increased in the suburbs around there, it's amazing that some of those trends are going to turn around.
Sure.
And so you don't want to get stuck in that position. So that's one of the things to really look for as well.
Well, what's the old phrase? Cooler heads prevail. Let's be rational in our thinking here. You got a couple charts. I think that these might be great at helping validate or add some firepower to the discussion. Let's start off with the one about monthly single home inventories. I think that's a very interesting chart. I'll let you walk our viewers through that one. Do you have it there in front of you?
I do. So if we look at, a lot of times we think that the way that inventory works with real estate is that it works on a buyer's market or seller's market and a neutral market. Okay. So we typically say that if there is two, like right now you can see it's 2.1% inventory of existing single family homes right now. What that means is that if you drew a line in the sand right now, today, and didn't let any other properties come on the market, it would take 2.1 months to sell every property that was on the market. That is an incredible seller's market. We usually say it's right at that 3-month mark, which you see back in 2019.
Right.
So anything that is over the 6-month market, where we're looking at in 2006, 2007, that means that really is a buyer's market, because if we drew that line in the sand in 2009, it was going to take 9.6 months to sell every property that was on the market.
Right. So tons of supply. And what's interesting, because what I notice up in Big Bear is kind of the thing now is everyone lists their house on a Thursday. And they list their house on a Thursday, and basically they just let it ride for the weekend. They're not going to do anything until Monday. But I mean, you're seeing that every house, and I literally mean every house that I've looked at, within that 5-day window already has multiple offers, dozens of offers, and is sold by that 5-day window. At least there's, they've accepted an offer. It's crazy when you don't have a lot of inventory and you have increasing demand. I mean, it's funny. It's just like the inverse of what's going on in bonds right now. You have so much inventory of bonds and no demand. Here at the housing market, you have so much demand and very little inventory. That's just a recipe for prices, which I think that's your next graphic here. I mean, this is a pretty significant jump over the 2019 prices.
Absolutely. And then one thing I do want to just say about inventory again is that inventory can also be very micro. So you can have inventory. I remember back in the recession, this is the best example I can think of. Back in the recession, I was in Denver and we were doing some real estate classes there, and I was doing some research. And anything under $250,000 in Denver at that point in time was on the market for less than 3 months. I mean, they were going. It was quick. Anything over $1 million, I'm not sure you're ready for this, was on the market, was 19 months worth of inventory.
Wow.
So you really also have to look closely at what exactly you're looking for. One of the things right now we see in Southern California is single family homes they're just killing it. But condominiums are kind of different right now. So that there is, if we looked at inventory, those would be higher inventory numbers. So depending on what exact asset you're looking for, you've also got to keep that kind of in mind. So the next one we were looking at is the annual home price appreciation.
Yep.
And I think that if we look at it compared to back in 2002 to 2005 and to what it is now, I think that those numbers have been going up at a more reasonable rate. And the other thing that's really different that we're seeing is that people have a lot more equity in their home, where before, back in 2006, 7, and 8, we knew that people were buying it with, negative equity in the property, right? They were getting 110% mortgage on a property and thinking, oh, it's going to go up,
right,
next month and I'll be in good shape. We're not seeing that right now. And some statistics that I've seen have said that, and this is nationally, but that most 50% of homeowners have over 40% equity in their home right now.
That's good. And do you think that that's partly due to the fact that lenders aren't going to do a 110% mortgage?
Absolutely.
Yeah.
And even it was kind of funny because at least from what I was seeing lending standards starting to get back a little shady again right before the pandemic hit. And I'm like, oh, okay, we're going down this road again. And then all of a sudden now it's just come to a screeching halt again.
Good. I think the lenders have to look at it from a risk management perspective for themselves. Of course, they'll get bailed out, but you don't
Isn't that the truth? No.
Sadly, that is definitely the truth. Let's see. Subbises, do you think that the chasing that you're talking about, people rushing into piles of debt, could be an issue if the economy doesn't recover? And I think maybe more so, let's just say that we all of a sudden have the economy starts to go down or the market starts to go down again. Do you see this big rush into real estate as being a risk event?
That's pretty interesting. And it was funny. I was talking to a gentleman we both know, Steve, earlier today, about doing your show and what our topic was going to be. And one of the questions he asked me is like, do you think inventory is going to increase once people have stopped the moratorium on their mortgage payments and banks go after foreclosures? And a lot of people may be aware here in California, there's also a rent moratorium as well. And I really don't believe that. We don't see those numbers increasing because of the fact that people have more equity in their homes than they have in a long time. And so if they're forced into a position of having to sell, even if the market was, let's say you saw a 10% drop in the market, right? But somebody's sitting with 40, 50% equity in their property,
right,
they're not going to go into foreclosure.
Right.
They're going to sell their property. That's where there's a big difference to what we were seeing before in the past. And so I think it may very well, we may see some inventory start to creep up a little bit, but I don't think it's going to be huge. And I have a hard time believing that I think that this last year for our economy has really kind of trimmed a lot of fat in a lot of places. Mm-hmm. And so I'm hopeful that the real estate market will continue to grow.
Yeah, I mean, the bottom line is we don't know. We can go off of what we've seen historically and formulate some opinions. I'm a little bit more thinking that there may be some systemic issue from a collapse in the equity markets and people not being able to make their payments. But, if the data says that there's that much built up equity, then that fall could be much more substantial before it actually starts to impact like it did back in 2007, 8, and 9. It's a very good point in seeing how much equity people have, because I think what was happening, Dan, is people were pulling equity out of their homes to buy all sorts of other stuff, including laddering with real estate. So I'm taking equity out, I'm going to go buy another place and another place and another place. So one small change there creates this domino effect in the housing market, and I don't think we're quite seeing that. Although, that said, I've talked to a few people like, oh, I'm buying this house and this house and this house. I'm like, that sounds like the 2008 crash.
Well, yeah. I mean, and if you go back and you look at The Big Short and who was in, especially that was demonstrated mostly in Florida, right? Mm-hmm. And also looking at builders and what builders were doing at that period of time. I will never forget going to a seminar, and it was put on by a builder, and the builder trying to tell me to buy the if I didn't get into this what do they call them, not the subdivision, but what this
it's not, isn't it a subdivision? Like, it's just a project. It's just to build a specific
project or whatever this phase. That's what they call them, phases. If I didn't get into phase 2, I was going to be pushed into phase 4, and by the time I got to phase 4, prices were going to be 25% higher. And I'm just like, why do you think he could never answer that question? But that's what the builders were doing. And so they were just building and trying to build the momentum to get it there. And when it fell, there was no value attached to that. So now people had put, deposits down on properties that were 35% above what they could go out and walk into a house and pay for it now on the future build. So it's pretty interesting, and I see builders being a lot more cautious today in what they're doing and how they're building.
Let's dive into that category. I've heard some comments recently from home builders. You're talking, KB Homes, Lennar, even things like the XHB have been on a pretty significant tear. And most of the comments out of there are extremely optimistic and things moving to the north side here and keep moving up. What's your take on the current state with home builders? It seems like they just don't have enough inventory for the demand.
They don't, and I think they're being a lot. They may be talking very positively, but I think they're being much more cautious. No. And then one of the other things that is kind of a new trend, and it's been a trend for probably the last 3 to 4 years, but it's really pushing that trend even bigger, is that home builders are now also building, they're creating funds where they're building to rent. So there's still a sizable market out there that doesn't want to own. They just don't want the hassle. Sure. They are from that mindset is that I want to pick up the phone, call somebody, and I don't want to have to deal with it, but I want to live in a house. And so they're building these communities that are all totally rental communities, and they're building them by utilizing a fund. And then when the market gets to that point, and I think in some places they're seeing that, where there is so much demand that they can sell those homes, then they can go back out and sell those assets. Mm-hmm. But that's a really interesting model that I hadn't really been exposed to in the past.
Yeah. Great question here from Sava, and obviously everyone is in their own different financial situations. He says, with all the craze in the housing market driving up prices, what would you suggest someone in their upper 20s to save for to get into real estate? 3 to 5 years. Let's say 3 to 5 years from now, if you were saying someone wanted to get into real estate, what would you suggest to them to save?
Well, it really does depend on that particular market. But we know that if you have 20% down in whatever that price point is in your market, you're going to get much more favorable loan rates. You're going to get more favorable interest rates. You're going to be in a better position to go out and compete. You're going to be in better, even if the market still is where it is. There are 5% loans out there, right? But those people that person competing against somebody that has 20% down right now, they're going nowhere. They cannot get an offer accepted because they're not really that desirable. And so if you can really look at 20%, that is a great place to start. Also, you really want to try to have like maybe 6 months reserve. If you're looking at buying a rental property, you really kind of need 25 to 30% down, and definitely need 6 months reserve if you want to go out and buy rental properties right now. Rental properties are an interesting thing to me. I see that depending on what market you're in, I'd let things settle a little bit before I'd go out and buy something at this point in time.
Yeah, I think the challenge there, Sava, is we're all in different, let's just say, financial situations and geographic areas. So, if you're looking for 3 to 5 years out, depending on where you live, I would get an average of what prices might be or home prices might be. And, Diana's got some great calculators where you basically run an estimate of your personal income and expenses and liabilities. And once you have all your numbers down, then you can look at that objectively and say, I can afford X amount per month without it being a burden, and know that I can do that with, let's say, 6 months reserves in the bank, and I'm comfortable. I think part of the challenge is now people who are buying right now might be chasing a bit, paying a higher price, and that FOMO could cause them to go past that. So let's say, for example, you did some research and you say, all right, I know that I can afford, let's say a $350,000 house, and I'm going to commit 20% down. That gives me $70,000 down, which means I'm going to have to come up with $280,000 mortgage. At current rates, you're looking at maybe $1,500 a month. And that would be with your property taxes and insurance and things like that. I'm using rough estimates. And you got to ask yourself, can I afford $1,500 a month? If you can't, then you need to put yourself in a different situation where you're either making more, so you can't afford more, or you buy a house that's going to be a little bit cheaper. But ultimately, I think the biggest piece that I would recommend is you never buy something that's beyond your means. Never go outside of what you can afford personally, or that's going to pinch you in other areas of your life. Because all of a sudden, you're now going to start making sacrifices in your personal life that you may not want to be making, and put yourself in a situation that if you do lose your job, those reserves could be eaten up much, much faster. That, to me, is much more important than saying, I'm going to buy this type of house. It's what can I afford and not get screwed on in the future.
Absolutely. And I think somebody in their 20s as well really wants to make sure that they've gotten themselves in the best position, in the senses that having some savings, having some 401k, and if they have any student loan debt, making sure that's paid off.
Yeah. Because
those are the things that are really going to put you in a better position to move to that next level.
And also credit. You did a great course for OTA dealing with credit. You guys might want to check that one out too. When you go to finally get that loan, you want your credit score to be as high as humanly possible. If you're over 800, you're going to be in a great position. If you're down in the 500 or 600, you're going to struggle, and you're probably not going to get the loan you want. And that teaser rate that you see of, let's say at that time it's 5%, yeah, you're probably going to pay 6 or 7.
Yeah.
So I would work right now at getting my credit score as high as possible. There are some great videos for that through Online Trading Academy I can reference that you guys should check that one out. But to me, that's probably the biggest steps you can do to set yourself up, to put yourself in a position where you can go to the top of the pile from a lending perspective. You can get pre-qualified for a much bigger loan if you need to. But credit is a massive one out there. 750, Medic says 750. 750 is great. For my lending buddies out there, 720 and above, you're pretty good. 720 is kind of the benchmark you got to strive for, but let's not stop there. Shoot for 800, man. Get
it. Absolutely. And you have to realize how much money that'll save you. I mean, just do an amortization table of a property at, 3.5% interest compared to 4.5% interest, and look at the amount of money that would save you over a 30-year period of time, or even if we're talking about a 7-year period of time.
Interesting question. I'll run through this one very quickly. Sava says, what would happen with people's mortgages if the dollar plummets? In all honesty, nothing would happen with the mortgage because the dollar plummeting is not going to impact. You're still making the same amount of dollars from your employer. So if you're a $1,500 a month payment, you're still paying $1,500. What a plunging dollar would probably do, though, would actually further exacerbate bubbles in our marketplace because a cheap dollar is generally bullish for the equity markets, and that causes more money to pour in because they feel that, more goods and services are going to be sold. So a plunging dollar would actually be good for you if you owned a mortgage because most likely that means that your property value would be increasing with the overall euphoria for the markets. Now, we aren't in that situation right now. We're actually seeing the dollar start to rise a little bit here, which has been interesting. I'm not sure exactly if it's going to be returning to an uptrend, but it's been moving back up here recently, and that may be a factor for the equity markets going forward, but we got to wait a little bit further to see how that one all pans out.
Well, and it's also interesting if you want to talk about it from an inflationary standpoint as well. And that's one thing about when you buy a property and you buy it with, a fixed mortgage, you are fixing your payment into the future, right? Do rents typically? How many times have we really seen rents go down?
Yeah.
So if you continue to rent, all you're doing is increasing your monthly outflow, as opposed to when you're buying, you're stabilizing that, and that gives you a lot more power in the market.
Where was that question? Boy, I got a whole bunch. And this is a good one as well. And simply because it's one of the things I was thinking of doing with my property. I'd love to get your take on this one, Diana. Tom says, I'd like Diana's thoughts on buying an existing Airbnb in an area like Big Bear or Central Coast when the market cools a bit. So, this is obviously Big Bear. This is a huge thing up there. When you're looking at an Airbnb, got to remember first that just buying an Airbnb doesn't mean it's going to sell. Right, you have to work and create an environment that makes it very desirable for people. So
it's a business. It's not just a rental. It is a business.
Absolutely, and it's curb appeal. It's all the little amenities that people have on their property. So just buying it doesn't necessarily mean it's going to do well. You're going to have to work at it, but. For those types of environments, obviously, if you're buying a home wherever it is as an Airbnb product. You have to make sure that the numbers all make sense to you. So, if you're buying right now at an elevated market, well, does that mean you're going to have to rent your place out at a much more elevated price? I mean, to me, this becomes a little problematic when you're dealing with Airbnb, does it not?
Absolutely. And I think that it deals with more of a fluctuation in what's going on in the market. If we look at a lot of people always take, and I'm all about being positive, but always say, okay, I'm going to buy Airbnb and I'm going to rent it out 52 weeks out of the year and look at this incredible profit that I'm going to have. Well, that's not realistic, right? Mm-hmm. So we really have to look at it from a realistic standpoint. They also don't take into consideration the cost. Now, sometimes in Airbnb, you can pass on those costs in the sense as you can pass on the cleaning, right? So if you have to have somebody that comes in every time it's a turnover to clean that property, what does that look like? Can you pass that on? And when you're looking at Airbnb and people are looking at the rental rates, it is more desirable, in my opinion, to keep your rental rate a little bit lower. And then when you add on the cleaning fee or whatever your additional fees are, people don't tend to see that total as much as they do just that daily rate.
Right.
And so, but you really have to look and find out in that market, what are the typical number of days you're going to be able to rent that property out for? What are the high seasons? What are the low seasons? How do those time frames change? My youngest son and his wife had a property in a place called Palm Desert. And they happen to be, he's the one that's in commercial real estate. He's pretty smart at what he does. And they bought this property that was right next to where they had Coachella and what's the country one? Whatever that country stagecoach is.
India.
And the tennis tournament. Yep. And from those three events, they could make their mortgage payment for the year.
Wow.
That's amazing. But what happened last year?
Right. Yeah. Yeah.
And what did they do? They pivoted and they found somebody that was in Washington that wanted to get out and wanted a 3-month rental. And so they made a deal. But you've got to be able to work and be able to be proactive when it comes to that stuff. It doesn't just do it on its own, and that's what a lot of people think it does do.
Let me switch here. I know I want to wrap up because I'm keeping you late here, and I know you're very, very busy. But Mike, one of our regular listeners, he's got a really good question, and we're seeing this a lot here in California, whether it's because of your political views or you're just tired of paying all the prices. Mike says, I'm a homeowner for 35 years, but want to leave California and keep the home as a rental. What are the pitfalls? Are there certain things that he should be paying attention to with regards to leaving the state and doing that as a rental?
The only thing that I would say is a couple things to look out for. If you make it a rental right now, that's going to give you greater tax advantages. You have to talk to your tax accountant. I can't say that, but we know that there are going to be things that are deductible that are not deductible as a homeowner. And if you're at 35 years, you're probably, maybe you refinanced once or twice, but you're probably pretty low on your interest. You can now start to depreciate that property. So there's some real big advantages from that perspective. The only thing I'd really be concerned about is the politics that's happening here in California and what that means to you. So you have to keep your eye on what new laws are being created, if there's going to be a change in what we call Proposition 13, which is your property tax, because if you've owned your home for 35 years in California, your property taxes, I imagine, are really very low.
You're loving it. You're loving it.
You are loving it. And that's one of the things that keeps people in their homes in California, really is Proposition 13. And if they change that, I'm not sure what's going to happen to the state related to that. Also, one of the other things to keep in mind if you are an investor is keep your eye on what's happening in Washington with 1031 exchanges. And so there has been a lot of talk about that, and we can do another segment on that. But I think those are a couple of really political hot buttons, and it's not left, it's not right, it just is what it is. And what is it doing to your wealth bucket that you have created? And you've got to be proactive on that.
Oh, Diana, I could keep going, but I told you 30 to 40 minutes. We're already past that. And mind you, this show was supposed to be a 30-minute show period, and they keep me an hour every day. Like I've done... Anyway, wow, thank you so much for all the information. Is there anything that you're doing, classes, newsletters, anything that we can promote for you?
I would just say keep your eye on the prize, and we've got things that are coming up, but nothing I can really promote right now. I'm still with OTA, and we're supporting our real estate students, and we hope to be able to come out and start creating some more students soon. But really make sure that you're really careful about where you're getting your information, where you're getting your data, and stay on top of the markets.
Diana, I really appreciate you coming on. I know it's been far too long. I'm going to probably bug you and see if I can get you on every month or two or somebody from the real estate side, because I think it's one of the more important topics. If you think about it, like we go buy a stock and I might buy $50,000 worth of stock, but here I am with a $1 million home. I mean, this is pretty important stuff to think about. So thank you so much for sharing some thoughts on where the market's going. Next time we'll field questions earlier, hopefully, and get a little deeper.
You got it, Merlin, and you obviously have a passion for it. You always have, and I always enjoy being on and chatting with you.
My pleasure. All right, well, we'll talk to you soon. Thank you so much.
Take care. Bye.
Take care. Bye. Guys, that was Diana Hill giving us some insights into the housing market. It is one of the biggest asset classes out there. Tons of stuff to think about. And, next time, and I apologize, there were some great questions came through I didn't get a chance to get to. I wanted to make sure we got Diana off on time. There was a good question about New York, and maybe we'll bring this up next time. When you guys see that I have Diana or a specific guest on, if you got all these questions in here sooner, I would have had the time to look through different settings and sources to find out more information statistically about various areas. Now, there was one question. Where was it? Yes, Alex, great point here. He says, with Airbnb, you really got to go and check with the local realtors because they will know more about what the codes are for Airbnb. As Alex says here, some counties, some cities are putting limits on the number of Airbnbs. Others are saying you can't do it, period. So you can imagine you go buy a house thinking you're going to Airbnb it in a desirable location. They go, yeah, you can't do that here. Now all of a sudden you got a big problem on your hands. Let's see, where was that question? Boy, now unfortunately I can't. GD says, is now a good time to get a place in New York? You know, is it not the same thing that we talk about with equity markets, which is when there's blood in the streets, you want to be a buyer? Well, from my understanding, and I haven't seen all the numbers, and maybe next time we'll do a little bit more of a special show on that, it sounds like, you know, New York is seeing, city anyway, is seeing like an exodus. And of course, when you have an exodus of people, prices are going to drop, right? When everyone's saying, I'm not buying, I'm getting out of here, selling stuff, it could create a great buying opportunity. I don't know. I'm not a New York guy. Personally, it's just too busy, fast-paced for me. I prefer to live in a little more elbow space and have some land out here in California. But those are obviously great things to think about. Now might be a time to buy. Or maybe you wait for it to turn around a little bit as opposed to catching that falling knife. So next time we bring Diane on, we'll talk more about that. Sorry, I could have gone on and on and on and on about different housing questions and topics today, but it was a treat to get her on. It's been a long time since we've had Diana Hill on the show. All right, for tomorrow, I didn't create graphics today for what's going to be happening tomorrow. I think the most important thing for tomorrow is at 11 a.m. you do have that Pacific time, you do have the FOMC rate announcement. Right now, they're expected to stay at 25 basis points, but there's a plot graph that everyone's talking about right now, and all of a sudden, they're starting to think that the Fed officials, the Fed voting members, are actually thinking about potentially raising rates and seeing that the rates are going to be rising going forward. That means, in my mind, that we have an issue with inflation right now. And I don't really see it that bad, but this is the Fed almost forecasting higher inflation if they're thinking about raising interest rates. Boy, that could be definitely one of the things that puts a little bit of a damper on the party that we've been experiencing since those March lows or since 2009 for that matter. So that number comes out tomorrow. Other than that, there's not too much more. You have some CPI numbers for Canada tomorrow. Earnings-wise, is Oracle tomorrow? I do believe that Oracle is tomorrow. I will check here very quickly because I have the ability to do so. Real quick. Where's my next day? I thought Oracle was actually on Thursday. Oh, tomorrow you have 10 cents. So Oracle's on Thursday. Tomorrow you have 10 cent and Five Below reporting earnings, and that's pretty much it. All right. What did you say, Alex? Property in Europe is cheap right now. Well, it's a tricky one because yes and no. Here's glad you brought that up. Yes and no. Here is the chart of the euro dollar, and this is on a monthly. So basically, you guys see that this has been rising. This right-hand side of your screen, right? It used to be 1.08. Now it's 1.19. It was almost 1.24. What that means is that the euro is getting stronger. So while you may look at something and see that it's trading for 100,000 euros, well, that's not $100,000, right? If you bought something right now that's 100,000 euros, that's 119,000 US dollars. So you have that conversion rate. The euro is getting stronger right now, certainly for the past, we'll say, year and a half. It's been getting stronger and stronger. Now, this looks like a decent uptrend here on the shorter term. If I say shorter, I'm looking at the monthly time frame. But always take that in consideration. If you are thinking internationally, don't just think of the real estate prices themselves. Think of the currency. So, like, for example, if this euro had looked like this, let me real quickly modify this. Bear with me. Okay. Scroll over here for you. And let's say we had a monthly chart that looked like this, right? It had gone from 124 all the way down to 108, the exact opposite of what we saw right now. What that means is you would be gaining in value or being able to buy much more property than you would have before. So a falling euro, if you were to buy something in, let's say, Europe, and you want to go to Italy or France or something, you'd be able to buy a lot more. So anyway, there you go. Yeah, the euro did climb quite a bit, especially against that dollar. That's, I'll measure the move here. And again, this is a monthly time frame, but if you look at the lows there to our peak, you're looking at a 16% increase. This isn't a currency pair. That, an equity market, that's one thing, but for a currency, that's a pretty significant move. This was a major factor for me when I moved to Italy. It's one of the biggest learning lessons ever is buying a home in Italy. I should have bought it, and I'll tell you the story. I gotta remember all the numbers. It was so weird. When I first moved to Italy in 2001, I saw a place and I thought about buying it. It was 250,000 euros for the place. At the time, the euro was trading at 0.86 to the dollar. So even though this is a 250,000 euro home, it would have cost me something like $190,000 to buy it. Great, right? That sounds good. So my dollar was strong back then. And then all of a sudden, the euro just went crazy and got up to 1.4, I believe. I have to look at this one. It's been so long ago. It might have even gotten higher than that. But that was back in 2000 and... yeah, we went up to 1.35. So 135. So we went from 0.86 to 135. Now all of a sudden, that same home, instead of selling for 250,000 euros, was 500,000 euros. And you're thinking, well, great, that's $500,000. No, it's actually way more than that in dollars, right? Because it's now in euros at 500,000, trading at 1.36. That's going to be 500 plus another 15. You're looking at almost $680,000 home that you would have gotten. So would have paid 200, 180 or 200, gotten 680, all because of dollar conversion. Anyway, I had to share that one with you. That was just one of those ones I was shaking my head going, man, I can't believe I missed that one. All right, that's going to do it for me, guys. I'm going to wrap it up before I get to an hour. I got 9 minutes left, but I got to start reining back in these shows. I got so much other stuff I need to do. Tomorrow, we're going to have Tilly Allison on the program. We're going to talk about some of the energy pieces. Tilly loves to take a look at the big picture and see what's really driving markets at this moment in time. And it might be a nice, interesting contrast between what Scott McCormick was talking about on yesterday's show and what Tilly talks about, because Scott really likes to look at that big picture. Tilly does as well, but she's going to be a little bit more active in her investments, I think, than Scott might be. So it would be great to get these two perspectives. So Tilly Allison will be our guest tomorrow. If there are questions regarding today's show or things you want me to cover, questions for Tilly for tomorrow, email me, TraderMerlin@gmail.com. That's probably the easiest way to do it, to get involved. Of course, we loved all your participation today. Thank you so much. For those who might be new, hit that subscribe button, and I hope I get to see you all again tomorrow. That will do it for today. Take care. We'll see you tomorrow.